The plan would make community banks with less than $1 billion in assets eligible for lower cost capital if they meet certain conditions. For more on the administration's plan, we are joined by White House economic advisor Jared Bernstein. Jared, thanks for coming to the show.
Sure.
Let's start first talking about this plan. I mean, it sounds great, and people have been cajoling for more lending to smaller businesses for a long time. Are they ready? Can they handle it? Are they creditworthy?
Are the borrowers creditworthy?
Yes.
Is that the question? Yeah. Look, I think what many small business folks are telling us, telling the president, that creditworthy borrowers who are well capitalized, who have good projects that can yield positive returns, maybe they're trying to roll over some debt that in normal times they'd be able to do so. Maybe they're trying to fill out their inventories or make that extra month or week of payrolls. They're not able to do so, not because of their credit record, but because the system is locked down. There's a risk aversion out there because of the financial meltdown that we were talking about a year ago. Now, the Recovery Act intervened in this space and helped kick up loans to small businesses, over 30,000 loans through some of the programs of the Recovery Act. But it's not enough. There's still credit constraints facing small businesses, and they're a driver of job growth coming out of a downturn like this. So today's announcement, what you just went through, some of those aspects of the plan should help creditworthy borrowers get the lending they need.
Jared, you mentioned 30,000 businesses by the already existing plans. 30,000 small businesses were helped out. So this adjustment, if you will, how many small businesses do you think it will ultimately help?
You know, we can't say right now. I mean, what we're doing, though, is providing significant capital through the TARP, and as the president just mentioned, winding down the big bank part, moving now into the smaller banks, assets less than $1 billion. These are the banks that are most likely to lend to smaller businesses. You know, the larger a bank's asset, the smaller share of their lending goes to small businesses. So this is the right target. And then there's the legislative question, which is the raising the caps on the lending through the 7A and the 504 program in the SBA. That has to go through Congress. So it's hard to say the extent of it right now. What we do, but I can solidly assert that there will be a lot more liquidity for creditworthy businesses to borrow.
Speaking of legislative processes, there is a move to expand unemployment benefits that's been stalled in the Senate because of disputes over how to pay for it. We talked to you a few weeks ago when the president says he's willing to look at any additional measures to help alleviate unemployment, create jobs. What do you think about this? Is the White House behind an effort to really extend unemployment benefits and actually spend money to create more jobs?
Look, I'm not going to talk about any specific policy on that front. What I will say, and I think the president and NEC Director Summers have made this point as well, we know that long-term unemployment is historically hugely elevated. There are a lot of people stuck in unemployment right now, and they depend on unemployment insurance. Now, through the Recovery Act, we created 79 weeks of receipt for unemployment insurance, depending on whether your state meets certain conditions. Never before in the history of this program have there been that many weeks of UI for workers, because we know the depth of this recession. I think we've shown that we're willing and able to spend some serious Recovery Act dollars on helping the unemployed and on creating jobs. Beyond that, we're going to have to watch and wait and see what's needed.
Let me ask you about executive compensation. We're hearing that executives at 7 bailed out companies, including Citigroup and Bank of America, will have their pay cut about 50% after negotiations with Ken Feinberg. We're going to do this.
Look, this is a report that we at the White House cannot confirm yet. What I will say, and I think we've talked about this before, let's understand the nature of this intervention, if in fact this report is correct. You've got a number of large banks who are still borrowing from the TARP. They're still TARP recipients. Okay, so Ken Feinberg's job is to monitor the executive compensation at those institutions that taxpayer dollars have pulled back from the brink and are now offering compensation over the moon. I mean, we've saved their bacon, and now they're eating our lunch. And that's just, I think David Axelrod used the word offensive. I think that's very much the case, and that's what Feinberg is here to accomplish.
All right, so maybe we'll hear about that later this week. Let me ask you about too big to fail, because it doesn't seem like the administration or Treasury want to move in the direction of breaking these banks apart. But Mervyn King came out and said that he thinks that's the right way to do it, which is the equivalent of a Ben Bernanke in the U.S. making that kind of recommendation. A lot of people have said nothing at all has been done to change the regulatory framework for banks. What's your take?
Oh, look, the people in the latter group simply haven't been paying attention. This president, Treasury Secretary Geithner, are involved in a level of regulatory reform for financial markets that we haven't seen in decades. Now, specific components of that reform can and should be argued about. I think if you talk to Secretary Geithner and the president, what they would tell you is that increasing capital reserves to reduce the really risky, dangerous leverage ratios that helped get us into this mess are a key component of financial reform hitting at precisely the kind of problem you were just mentioning. But when an institution does fail, that can happen. This is capitalism, right? When an institution does fail, we need the mechanism to take it offline without bringing down the system.
Well,
and that's what the reg reform is about.
You mentioned capitalism. If we really believed in capitalism, Jared, help me out here, then why didn't we let those firms fail last fall?
Well, that's exactly the point, that if because of I would argue, a level of deregulation, of speculative excess that crept into the system over the last decade or so, you had firms that posed a systemic risk. Believe me, as Obama has said many times, we didn't come here to get into the business of saving banks. We did that because of their interconnectedness with the global financial system. To let them come down in the interest of some ideological notion would have been to sacrifice not just our financial system, but that of many other economies.
So we would bail them out again.
But we're even bigger than before.
We did not have the systemic resolution capacity that we're going for under reg reform. That's the point I'm making. You know, you either have to break the banks up to make sure they're not too big to fail, or you have to have the systemic authority to take them offline without bringing down the system. We did not. We have not. We still don't have that authority. That's what makes regulation, reg reform so important to turn to as soon as we can.
All right. Hey, Jared, thanks so much for joining us. Always a pleasure. Jared Bernstein there, White House economic advisor.